Rules are meant to be broken, right? In today's video, we're going to be looking at two outdated retirement rules that a lot of people still live by, and these need to be updated and changed. The first one we're going to look at is the 4% withdrawal guideline. Now, Dave Ramsey, a lot of financial gurus have made this very prevalent, and they've talked about it quite a bit. But when it comes to the 4% rule, it seems like a lot of people are running out of money during retirement. The second one we're looking at is the 60-40 investment portfolio, which is kind of outdated. And a lot of new research and studies have said that it is going to change the portfolio and change retirement planning in its entirety. So stick around for the video. And if you're not subscribed to the channel, please subscribe, comment down below, and let me know what you think. So the first new report that comes from a financial research firm suggests that 4% is too high of a withdrawal rate for your savings account, which means during retirement, you are going to be running out of money as people continue to live longer. When you're thinking of 70, 80, 90 years of age, if you're taking out the regular 4% rule of thumb, like we've generally been taught, you are going to run out of money. And of course, when it comes to safer than a 60-40 portfolio, they want to break it down. So let's start with the 4% rule. So in 1994, William Bengden had the Journal of Financial Planning introduce the now famous 4% rule, which was a magic safe number when we were looking again. I mean, you're talking what, 30 years ago when this came out, and of course, adjusting for inflation every single year. Now, the very idea behind this means that within 30 years, you're not going to deplete all of your money. So if you're 65, you do that 4% rate, you're going to be able to retire or have money until you're 95, theoretically, is what you're saying. Now, of course, over the last 2-3 decades that we've seen, Morningstar has come out with their own research that says you're safer to withdraw less than 4% because what's happening is when you start adjusting this for inflation, you're running out of money by the time that in this article does pose that by the time you're about 83 years old, you'll be out of money, not the 4% lasting till 95. Now, assuming a 30-year portfolio with 20 to 50% stock allocation with a withdrawal rate of 3.7%, so even under that 4 is ideal. But this is only in the scenario that you're keeping 20 to 50% of your allocation into stock. That is where it really does make a big difference. You are staying invested in the market. Now, this is something that I preach for a long time, is that when you're thinking about retirement, 62, 65, 67, regardless of what it is, when you're looking at a 30-year runway or a 30-year growth rate, a lot of target date funds move a lot of money into stocks, move a lot of money into bonds, moves a lot of money into cash, a lot of money into safe. Where it does not grow like it needs to, it's not out hedging inflation, and you're really losing money by keeping it in the investment strategies. And that is why the reason when I look at my portfolio itself, even coming to retirement, 30 to 50% stock allocation is still going to be there all the way through retirement. That is not going to change. And of course, there are going to be ups and downs, but when you start looking at the growth needed to maintain that portfolio, 4% is too high of a withdrawal rate. It is not going to work. So generally speaking, the longer your retirement, the higher the stock allocation should be. So if you are retiring early, let's say instead of 65, you're looking at possibly retiring at 55, you need roughly 50 to 70% of your portfolio in the stock market to be able to grow through the extended amount of times. And of course, the less you should withdraw annually. So even looking at that, if you're retiring at 55, you should take about 2.5% of your portfolio every single year and hoping that growth factor really stays up. So for a 20-year retirement, so shortening it, so if you're going to retire, let's say 65, you're going to live to your 85, 20-year retirement, you can take roughly 5% out each year. But if you're looking to spend 40 years working free, you cannot exceed 3% at all. So there are a lot of different variables. Now, if you have an extremely aggressive portfolio, which I don't recommend extreme aggressive, you could withdraw even littler, taking 2.7% a year, and of course, going into early retirement. So the biggest fear for a lot of people, including myself, is you get ready for retirement. You've been working 30 or 40 years. You want to retire early. You do. All of a sudden, 20 years down the road that you're out of money and you're looking for something part-time to supplement Social Security because all of your retirement money has been burned through in its entirety. This is where it goes back to the old Dave Ramsey philosophy, where you keep the golden goose, you just take all the eggs, you take the dividends, you take the interest, you take everything, but you're not touching the initial principal. This, of course, does get into the initial principal. And the second rule that we look at is the 60-40 retirement investment portfolio. This, again, is something that I feel is so outdated. Talking to financial advisors, talking to investment advisors, when it comes to a 60-40 portfolio, they are looking at 60% stocks, 40% bonds. And then as you get closer to retirement, making that kind of a switch and a lot more money going into bonds, a lot less money going into stocks, meaning that you're moving almost all of your money at retirement into bonds or into cash at the age of retirement. Now, looking at the new study from the financial professors at Emory University and the University of Arizona have said that all gas, no break retirement savings will outperform the 60-40 because, of course, investing in the stock market for the longevity. They say 100% stock portfolio is the way to go and the only way to go all the way through retirement. So you are all gas, no breaks in its entirety. And if you called it right, their allocation is 33% US stocks, 67% international, which is crazy. Not looking and really going all equity, no bonds at all in a portfolio. Now, this is something that I have done and I've tested for a multitude of years, investing heavily in the S&P 500, thinking of investing in the tech side with my QQQM, and even investing in the dividend side with the HD. It has done incredibly well. And of course, this portfolio, I'm not going to do a lot of changes, not going to do a lot of alterations. Even when I go into retirement, I am still going to keep the portfolio. When I start looking even at the up years and the down years, even comparing to like a BND or something that is in the bond market has grown about 2% over the last 10 years. When you think of the average performance of the S&P 500 of roughly 10%, it makes sense to have 5x the growth on average going into that S&P 500, which is crazy. Now, the author really approaches this as it vastly outperforms all other portfolios in the terms of building and preserving wealth during retirement, sustaining retirement wealth as well, creating generational inheritance, or in other words, having a large amount of retirement savings that remains after you die to pass on. And of course, we've talked about generational wealth quite a bit, and it is something that I absolutely want to do. So if you think about this, even starting a portfolio at age 25, and when you start putting it in and putting it all into the market itself versus doing the bonds versus doing the 60-40 portfolio, it is kind of crazy. In terms of retirement wealth, you'll need to save 16.1% of your income in a target date fund and 19% of your income in a 60-40 portfolio to make up the exact same. That is because of the underperformance of bonds for an extended amount of time, meaning that when you start looking at an all investment portfolio, you only need to save 10% of your income in that all equity portfolio to have the exact same gains. Now, when you start running the numbers, it is incredible to see the difference, which when you start doing compounding interest, when you start looking at a multiple of years. So again, if you think at age 25 and you're going in and doing a target date, 16% of your income, if you're doing the 60-40 portfolio, 19% of your income. If you're going all in equities, it goes down to 10% of your income. Now, of course, the drawback to this, and the only drawback, stocks can be very volatile in a 100% stock portfolio, which of course can inflict psychological pain. Now, this of course is where you as an investor have to use emotional intelligence, have to use your common sense, have to think about the longevity of the market in the 10% average return that we've seen with that S&P 500. This means when the market goes up, you're purchasing. When the market goes down, you are purchasing as well. It is really dollar cost averaging through an entire lifetime that you can have an exceptional portfolio that will be 100% stocks, that will be 100% equity, and overall, it will do incredibly well and will perform incredibly well over the extended amount of time. So, all right, guys, so that is going to do it for today's video. And ditching these two retirement rules or strategies, let me know in the comments what you guys think of them. And as always, thank you guys for watching.